Hi, everyone. Welcome to today's webinar, Defending the Community Reinvestment Act, also known as CRA. Today we have with us Frank Woodruff, who is the Executive Director of the National Alliance of Community and Economic Development Associations, and the network's very own Senior Policy Coordinator, Arnold Cohen. I'm Nina Renero. I'm the Communications Coordinator for the network, and I will be guiding this presentation today. Just a reminder, we will have this recorded with the actual recording and the PowerPoint slides posted on our website. The web address will be posted at the end of the presentation. And everybody will be on mute throughout the call, but feel free to type in your questions in the question box on your dashboard throughout the presentation, and we'll be happy to have Frank or Arnold answer your questions. With that, Arnold, would you like to kick it off?
Absolutely. So the CRA, Community Reinvestment Act, was first came into law in 1977, and it was a very critical piece of civil rights legislation. So in response to discrimination against low, moderate-income people, people of color, in trying to own a home, get loans, and other banking activities. As we know, some redlining still does exist as a result of CRA, but CRA continues to be a critical tool in trying to address that. The current change in regulations by the federal government that will be talked about more, unfortunately, look to really weaken the CRA requirement rather than all different kinds of ways we can think of to strengthen it. We'd love to see with new players doing loans that are not traditional banks and other potential ways to be strengthened. CRA has been an important tool for us here in New Jersey. The Community Development Network has been involved with citizen action in negotiating agreements with banks that have resulted in more than $40 billion of commitments to low and moderate income communities across the state. We've been involved with over 40 financial institutions in coming up with those agreements. And CRA has really, I'm sure, helped many of the nonprofits on the phone with being able to get access to loans and grants and help the work that they do. You'll see on the slide some of the type of contributions that CRA makes: below market mortgages, discounted home improvement loans, consumer lending products, construction loans, small business loans, loans to women and minority institutions, as well as grants to many of nonprofit community development corporations around the state. So it's a very important tool that, if anything, needs strengthening, and we need to do everything we can to combat the current efforts of this administration to weaken CRA. And I turn over to Frank Woodruff from NACEDA to talk more about the details about how who is threatening CRA and how that's happening and what we all can do about that.
Thank you, Arnold. Hi, everybody. Frank Woodruff with the National Alliance of Community Economic Development Associations. As you'll see on our national membership map, for those of you who aren't aware, NACEDA, we're an alliance of 40 state and regional community development and affordable housing networks across the country in 25 states, including, of course, the Housing and Community Development Network of New Jersey. I'm going to jump right into the details of what the Office of the Comptroller of the Currency has proposed, the politics behind it, what NACEDA's critique of the proposal is, and then a little bit of what we're adopting as a strategy to get the outcomes that we're looking for, that our communities need. So just as background, the Community Reinvestment Act, as many of you are aware, regulates banks to invest in the communities in which they have branches, as Arnold alluded to, there are 3 regulating agencies, and this is a really important point that I think many of you know, but I think it's worth reinforcing. The Office of the Comptroller of the Currency is one regulator. They are the agency that has put forward the ANPR, or the Advance Notice of Proposed Rulemaking. They tend to regulate the bigger banks. There is the Federal Reserve Board of Governors. The Federal Reserve is another regulator who is not officially participating in this Advance Notice of Proposed Rulemaking, and that's an important distinction to make, which I'll come back to. The Federal Reserve tends to regulate the more medium-sized banks and expanding banks. And then there's the FDIC, the third regulator, who also is not participating as of yet, and they regulate what's left of the financial institutions that are CRA regulated. And so, as someone from the OCC, the Office of the Comptroller of the Currency, told me about 2 months ago, he put it this way: each of these regulating agencies have their own set of CRA regulations that they follow. They are all independent. They just all happen to be exactly the same. And so that's an important thing to keep in mind, that in theory, each of these regulating agencies could apply different rules to the banks that they regulate, in theory. In practice, I think we're all on the community, on the mission-based side here on community development, as well as the financial institutions, as well as frankly regulators, acknowledge that is not practical for there to be different sets of regulations. So that is a tool we have in our tool bag when it comes to the politics of CRA reform. So the ANPR, I'm going to jump right into that. In early September, the Office of the Comptroller of the Currency, the OCC, put out a series of questions in the ANPR. If you have a chance to read it, it was linked to in the emails you were getting from the network, and if you get NACEDA's emails coming from us, but it's not that long. It's a series of questions from the eye of someone who is less familiar with community development. They look like pretty innocent questions. However, taken as a whole, the ANPR significantly misses an opportunity to ask critical questions about CRA modernization that has been considered by community groups, banks, and regulators and experts for decades, or at least the last decade, which has seen tremendous change in the banking industry. And so NACEDA's kind of big one-liner is that the ANPR misses a significant opportunity. The questions as a whole are oriented almost entirely toward easing compliance for currently regulated financial institutions. And that is that when talking with experts, that is only one piece of what CRA modernization could look like. I would acknowledge that, though I've never worked for a financial institution, that the process for them probably could be more efficient. And that is the only thing the OCC focuses on toward making it more efficient for them. And that, frankly, is not, CRA efficiency in complying with CRA is not the goal of CRA. The goal of CRA, the explicitly stated goal, is to serve the lending and credit needs of LMI communities in LMI communities. So the ANPR is not oriented toward accomplishing that goal. One of the key pieces, which you may have heard about, is the 1-ratio proposal, which attempts to provide a score, a singular numeric score for a financial institution to achieve in order to get a CRA grade. For the example they offer in the ANPR is that, let's say the ratio is literally a ratio, a numerator and a denominator. The denominator is for example, the bank's total asset size, right? Let's call it $100 billion. The numerator, regulators would say, is the number that bank is supposed to achieve in terms of dollars and cents as a percentage of their total assets that are invested in communities. In communities and maybe LMI communities, they actually ask that question too, whether or not low and moderate income people in places should be considered as part of the it should still be the focus of CRA, which is weird. We think it's a very odd question to be proposing. So you can imagine. So New Jersey is a little bit unique in that it's a large. There are rural parts of New Jersey, I acknowledge, although it is less rural than a lot of other states. So let's take, for example, a national financial institution that has a large bank presence here in Washington, D.C., where I live, as well as has a bank presence in, say, rural South Carolina. If I am a bank and my numerator is $10 billion, the concern that we have is that, well, why not put all those $10 billion in the easiest places, easiest markets to invest in? DC, right? Real estate here is competitive and can get expensive. However, the mechanisms to deploy those investments are familiar. And we're investing in rural South Carolina, where there's tremendous need, is less clear. And so the one ratio approach significantly calls into question whether the nature of assessment areas and where banks are supposed to deploy their dollars. The one ratio approach focuses on simply how much and calls into question whether or not assessment areas will even be part of CRA going forward. The ANPR explicitly requests feedback from commercial lenders. It does not explicitly request feedback from you or me or the network, but we're going to give them our feedback anyways. And I think that the OCC's focus on commercial lenders is something maybe, it opens up a strategic opportunity for us, which I'm going to go over here in a second. Formal responses to the ANPR are due November 19th, so in 12 days. So let's move on to the next slide, our NACEDA's critique on the ANPR itself. I've said some of this, but the fact that the OCC has chosen to do this alone, given the history and culture around and the norms around how these regulating institutions work together, is noticeable, and hints at disagreement among federal regulators as to whether or not this is the right approach. And that hint is something we should take note of and use to our advantage. As I went over the one ratio, so that's one critique, that the OCC has chosen to do this alone without other regulating institutions who have put a lot of work into what a modernized CRA could look like over the past decade, and frankly further back than that. The one ratio approach is fundamentally flawed, undermines the assessment areas. I went over that earlier, I won't repeat that, but the National Community Reinvestment Coalition, NCRC, some of you may be familiar with, estimates that over a 5-year period will result in between $50 and $100 billion in decreased investment from the private sector in low and moderate income communities over a 5-year period. And in the state of New Jersey, they estimate that of that 50 to 100 billion, 1 to 3 billion of it would be in New Jersey. So that we feel that the one ratio approach is fundamentally flawed. The ANPR does not consider other institutions which potentially could be subject to CRA regulations. And so it does, for example, it does not ask whether fintech companies who act like a bank and lend like a bank should be subject to some sort of regulation. It does not consider whether mortgage servicing companies should be subject to regulation or credit unions. And I think whether or not those should be considered, I don't think it's necessarily our role, at least at this point, to determine that. I think the bigger problem is that this has been a question that has come from the mission-based side of this work. It has come from currently regulated financial institutions, which have a harder time competing with other types, with the unregulated types of entities. And it has come up. These are questions that the regulators have considered. These are questions that have been considered kind of not in a public format yet for a decade. And yet this ANPR fails to even ask the question whether or not other institutions should be considered. So again, it's a missed opportunity. And the final critique is that the ANPR fails to incorporate fair lending or fair housing considerations in a CRA rating. to pick on our friends at Wells Fargo, for example, when they were accused of creating fraudulent bank accounts, or they were accused of illegally foreclosing on homeowners. Those rulings, those violations, were not considered as part of a CRA rating. And while it is challenging maybe it is challenging to incorporate all that into one CRA rating, it undercuts the credibility of a regulatory regime when a bank can get a satisfactory or outstanding rating while being accused of fair lending violations. And so how do we deal with that, right? And the ANPR, again, misses an opportunity to at least ask those questions in a formal public format. And so that is a fourth critique. So NACEDA, based on that, we have kind of adopted a three-pronged response strategy that we have been asking others, and there's a coalition of about 17 other national organizations that are part of this as well. And NACEDA, we are in a participatory role. I think others are more in a leadership role, but nevertheless, we're all on the same page. I wanted to be here with you all today to, first of all, draw your attention to how important this issue is, and to the extent you can work within your organization to be part of this, or be part of calling attention to how important CRA is more generally. It's really important. So the strategy for now has three pieces. First of all, respond to the advance notice of proposed rulemaking with your own organizational letter, with your own individual letter. If your mother wants to send a letter, that's cool. Volume will matter. Sign on to the New Jersey Network's letter, and sign as well as NACEDA's letter, and then go and send your own too. When you respond to the ANPR, there are several very good sample letters out there. The New Jersey Network put one out. We put one out. NCRC has a website that can help you get some data, and they have a really robust website. There are a ton of good examples out there, but I think the point is to send your letter in. It does not have to be complicated. In fact, it's probably better if not. NACEDA, we will not be getting into the technicalities of, whether this type of activity should be considered in the future or not. We are going to keep it really high level to really call attention to the missed opportunity that the ANPR has, missed. Because at this stage, we are frankly a little unsure about whether the OCC would take any kind of focus on the technicalities as an implicit agreement with what the process the OCC has used. And so we're going to keep it very process focused, and I think you can too. So that's the first piece. Get your letter into the ANPR by November 19th. As the name implies, the ANPR precedes an NPR, a Notice of Proposed Rulemaking, which hard telling when that will happen, but presumably but before the end of 2019, but who knows. So there'll be more opportunities. This is your first one. I really, really encourage you to send your own letter. It does not have to be complicated. And the network put out a really good version of the letter recently, and I'm sure we'll be sending it out again. So the second piece is the importance of the Federal Reserve Bank. So as I mentioned earlier, the OCC is going this alone, and frankly, from what we hear in DC, it's kind of the rumor mill, but also just the optics of it. If this was an effort by all three regulating agencies, they all would have been part of this ANPR, and they're not. So we got to make sure the Federal Reserve knows that we do not like the way this ANPR has gone. You can send your own letter to the chairman of the Federal Reserve, Jerome Powell. Our coalition sent one to his office a few weeks ago. We got a response. It was pretty vanilla response, didn't really say anything, but he did respond and did take it seriously. Your regional bank in either New York or Philadelphia, depending on where you're located in the state of New Jersey, if you have relationships there, I would let them know. I would send a letter to the head of the regional banks, letting them know that you're concerned. You can send a very similar letter to what you send to the OCC, talking about the importance of CRA, how you don't like the process the OCC has undertaken, and that we need this CRA modernization needs to take advantage of all the opportunities it presents. So the Federal Reserve banks are really, really, really important in this, and to the extent we can make our feelings known to them, will be to our advantage. So that's the second piece of the strategy. I should say, and also the Federal Reserve banks, also the FDIC. They're a smaller regulator, so I sometimes skip over them accidentally, but they're also important if you have connections or influence or relationships within the FDIC. And the last piece is advocacy to our banking partners. If everything the ANPR lays out were to come to fruition in some way, shape, or form, it would fundamentally reshape community development as a sector as we know it. It would significantly impact our ability to serve the communities that we serve, and we need our banking partners who have paid a lot of lip service and put a lot of dollars and resources, frankly, into serving these communities over the past 4 decades, and say that they are, a community bank or similar, to put their government affairs team, have it match what they've been saying. And as I said in one of the very first slides, the OCC is particularly looking for responses from commercial lenders, from banks. So if a bank is mirroring the language and the overall message that we are sending, they have a level of credibility with the OCC in this political environment that we do not have. And so to the extent we can convince them to be on our side with this, it will be to our advantage. So those are the 3 pieces. Happy to take questions. Arnold is too, I'm sure. I really want to thank the network for giving us an opportunity to draw attention to this really important issue. It is a long-term fight, and we're in it for the long term, and we know you are too. So I'll leave it at that.
Great. Thank you so much, Frank and Arnold. Really appreciate it. If anybody has any questions, now is the time to go ahead and type them into the question box for Frank and Arnold. And just a reminder that this presentation has been recorded and will be posted on our website. The link is right there on the slide. And the deadline to endorse the network's letter is this Friday, the 9th. However, the deadline to submit your own individual letters is November 12th. That's right, Frank? The 12th, I think?
I believe it's the 19th.
Oh, the 19th. I apologize. The 19th. Yeah. Okay. Okay, so we do have a question here. Someone asked, what if your CRA person is not the right person? They're not empowered, or they're just unwilling to take action. What do you do?
Good question. So yeah, it is conceivable that if you run an organization in X town, that the CRA person that you represent, if you go to them and say, we would really like X bank with us on this, they'll say something like, oh gosh, I would love to. That's above my pay grade though, or government affairs handles that in New York or in wherever the headquarters is. My response to them would be, don't let them get away with that. Their job, their job is to make sure the bank knows what is going on in the community. And if this is a concern for your community, that's their job to take that back to the bank. And so, in other words, we all have, good relationships with at least some of the banks we work with, if not all of them. And we can ask them to be our advocate within the bank. And in my experience over the last 2 months, as I've asked that of our banking partners at NACEDA, they've been really willing to play that role. They can't promise what their bank's stance on this will be, but have been willing to be our advocate within the bank. And so ask them to be that for us and for the communities that they serve as well as us.
Okay, great, thanks. It looks like we may have a question from Helen. Helen, are you there? Okay, let me see here. Okay, so Helen asks, the CRA exam now consists of several parts that include service to the community, including CD and board services. Will these no longer be part of the rating if there is only a dollar amount in investment being sought?
Good question. It's a little unclear, although I think the question is they'll still be part of it, though not as we currently understand it. So in other words, the service hours are a great example. So, a banker serves on your board, let's say they're on your credit committee, and they give 5 hours a month, how do you roll up those 5 hours into that numerator? There would have from what I can tell from the ANPR, though like I said, it is unclear. From what I can tell, they would probably attribute some sort of dollar value to each hour or similar in order for it to feed that numerator. When they say one ratio, the OCC literally means one ratio. So everything a bank does that it wants to get credit for its CRA rating has to go into that numerator.
Okay. Another question. Should we be talking to our members of Congress? Is there anything they can do?
Good question. Good. I left that out. Arnold, feel free to contribute to this as well. But it's but I mean, this is political, and you can't take the politics out of politics, as the old saying goes. And while this is a regulatory issue that the administration, at least as far as the OCC is concerned, has purview over, the Federal Reserve Board is not part of the administration, is therefore independent. And once you start kind of crossing jurisdictional lines, so to speak, it gets really political really fast. I think our elected officials being vocal about this, using the bully pulpit does have value. I just read there was an article in the Washington Post this morning about Representative Maxine Waters, who after yesterday's elections will probably be chair of the House Finance Committee, can gum up the process by calling regulators in for hearings, taking up their time, doing investigations, that kind of thing. So, there is a role for politics here. And I will say your Senator, Bob Menendez, on October 2nd, as part of a hearing of the Senate Banking Committee, grilled all three regulators who were in there for a hearing about something completely different, about CRA for a good 6 minutes. I watched the video. Stacy Berger had sent me the link to it, and I watched it, and I was impressed. So you have interest, at least among some elected officials in your state, to use the bully pulpit, and and you can lean on them for support.
And then beyond that, this is Arnold. We're working with our state legislators to pass a resolution condemning these changes. We're encouraging mayors and city councils to pass resolutions opposing these new regulations. Again, they do not have the effect of law, but I think we need to get this out in the public, and we need as many people to know about what's going on as possible. This is part of the idea of allowing banks basically to self-police themselves, goes against years of civil rights struggles, and the degree in which this is not a quiet issue that only a few of us know about, but becomes a public issue, is to our advantage.
Well, all that being said, with what happened yesterday, the way Congress is shaping up, and with who's in charge of the White House, is there any chance of any of these efforts succeeding? Like, do we have a shot here?
We absolutely have a shot, but they absolutely could succeed. I think the overall the overall intent of the Trump administration, especially when it comes to banking, has been fewer regulations, and this is a regulation that they would that falls under something they would like banks to not have to comply with, or at least comply with as much. The Wall Street Journal regarding the head of the OCC, Joseph Otting, a Trump appointee, there was a story in the Wall Street Journal about a month ago that draws attention to the fact that he led a bank which failed their CRA exam several years ago, One West in California, and he has a particular point of view and animus, those are my words, animus towards CRA because of his experience at One West. So I think he, as an individual, given what he's done in the past and frankly what he has said publicly, he very much wants to get this done. He will not receive resistance from his boss, President Trump, because of their general dogma towards regulations. And so I think it's very, very realistic that for something like this to come to fruition. But for the pieces of the strategy that I laid forward, encouraging the Federal Reserve Bank to play a bigger role and to throw their weight around, because it is not practical to have different sets of CRA regulations, to have the banks on our side that this is important, as well as to use our elected officials to our advantage.
Okay, and final question here. With regard to fair housing / lending regulatory matters, why is it that this is continuously overlooked in regulatory announcements as a concern to protect? Besides these letters, what other recommendations would you suggest to Congress?
Regarding fair housing, or I guess I'm not following the question exactly.
Well, I guess there's 2 points. The first one is with regard to fair housing / lending regulatory matters. Why is it that this is continuously overlooked in regulatory announcements as a concern to protect?
Okay, gotcha. So regarding fair housing, and you people on the line here probably know just as much about this, if not more. The new affirmatively furthering fair housing regulation came out a few years ago, under the Obama administration, and there was an effort within HUD. HUD had to make some real operational shifts in order to implement the regulation, and that was taking years, and not understandably so. It significantly beefed up the amount of information jurisdictions had to supply in order to confirm their assessments of fair housing within HUD, right? So anyways, that was taking a long time, but it was going forward. I had friends who worked at that department of HUD. It was definitely moving forward. The Trump administration, again, the deregulation dogma of this being unproductive to the economy, or whatever their argument is, has chosen under Secretary Carson to no longer enforce fair housing. And so the team within HUD that was working on beefing up in order to implement the new regulation were more or less defunded, or at least a lot of their funding was taken away. The consultants who were working on kind of computer systems have gone away. And so they've just chosen not to, as part of AFFH, to enforce that anymore. I would assume under in future administrations that could change, and probably would change, but it doesn't look like it's changing under this administration.
Finally, could you please elaborate a little bit more on how the modernization could undermine assessment areas? Would the required investments not align necessarily with all the markets that a bank operates in?
That's right. I encourage you to read the ANPR. It asks a series of questions. It's not that long, and make your own judgment on what exactly a 1 ratio would look like. But it's hard to imagine, and this is not just me. This is others in our coalition, and others have been following this for years. How a single ratio for a bank's score, if that is all they're held to account to, how they would be able to serve all of their. What would be their incentives to serve all their assessment areas if all they're subject to is 1 ratio? They're going to they are for-profit entities. That's not necessarily a good or bad thing. They are banks. That is what they do. They are a for-profit entity. But if CRA says that you need to invest in, I'm oversimplifying, but let's say you need to invest in communities that are 80% less of AMI and hit this ratio, why would they go? What is their incentive as a financial institution to go into under maximized real estate markets and make investments like the rural South Carolina example that I gave? Again, this is a complete shift from how we've thought about CRA before. Before it was they had to invest around where they had branches. Under one ratio, that there is no reason they can't change that part of the regulation. That is not part of statute. That is part of regulation. And so if they change that regulation and make banks serve only one ratio, they will serve the AMI communities that they see that is frankly easiest for them, or which maximizes profits. They are corporations who are designed to maximize profits. And so so there is the one ratio takes away the incentive. Let me put it this way. The one ratio takes away the incentive to make the harder deals work.
Okay. Well, thank you so much, Frank and Arnold. We really appreciate all this information. There's a lot of good stuff here. If anybody has any questions, feel free to send them to me, and I'll forward them to Frank and or Arnold. We'll also be posting this presentation by the end of the day on our website. And please don't forget to get your letters in by November 19th. All right. Well, thank you very much. Really appreciate it. Have a great day, everyone.
Thank you.
Take care. Bye-bye.